Hello, good morning, and a very warm welcome to this joint European Central Bank and Single Resolution Board seminar on CMDI. I'm Susan Carroll. It's my pleasure to be your moderator today. Our subject today is a very topical one, discussing the proposed changes to the crisis management and deposit insurance framework from the perspective of the supervisory and resolution authorities in the banking union, with a focus on the impact of the proposal, both ahead of and during resolution cases. Before we officially start, you should be able to see the agenda now on screen. Let me just give you also some information about our format, and most particularly how those joining us online can take part. We will take questions via the WebEx chat function, so you can simply enter your questions there at the right moment, and we will read them out for our panelists and speakers. For our in-person audience here in Brussels, you can simply raise your hands. Finally, a hint to all of our speakers today, we are on the record. We are live on WebEx from the SRB building in Brussels, and a recording of the seminar will be made available after today's event, along with the presentations on both the ECB and SRB websites. Now let's get started. It's my great pleasure to hand over to our joint host, Andrea Enria, Chair of the Supervisory Board of the European Central Bank in Frankfurt. Andrea, please.
Thank you very much, Susan, and good morning to all of you. I'm really pleased to be opening this joint seminar on crisis management and deposit insurance. And I would very much like to thank the SRB for hosting this event that, as Susan said, we organized jointly. The discussion on CMDI are at an important juncture, and indeed the end of the legislative term is approaching fast. And we have only a small window of opportunity during this term to make meaningful progress on a key aspect of the banking union. And I hope that this discussion today will help us having clarity on the features of the proposal, dispel misconceptions that I sometimes hear going around, and move the debate forward. Let me start by stressing that we have already achieved a lot in terms of crisis management inside the banking union. The SSM and the SRB, in very close cooperation, have done extensive work on recovery and resolution planning. Banks have much stronger capital positions and are close to the finishing line in terms of building the buffers of bail-inable liabilities. The Single Resolution Fund will this year reach the 1% threshold of core deposits, around 77 billion euros. And together with national deposit guarantee schemes, these provide the banking union with an overall amount of privately funded crisis management resources, which do not materially differ from what we see across the pond in the United States, which is a peer jurisdiction that we usually look at as an example of a virtuous track record of crisis management practices. And the ratification of the ESM, of the changes to the ESM treaty and the backstop to the SRF will add, a further backstop to enhance the confidence in the framework. Most importantly, the banking union has given itself a resolution framework that has been tested to successfully work in practice in the cases of Banco Popular and Sberbank. At the same time, the experience of the last 10 years clearly shows that there are certain shortcomings that need to be addressed. The European Commission's package does exactly that, and for this reason, it is strongly supported by both the ECB and the Single Resolution Board. I would argue today that the CMDI package increases the option available to supervision and resolution authorities when it comes to managing a bank crisis, provides a workable solution for mid-sized banks, and allows for easier access to existing crisis management funds while strengthening the cost minimization principle under harmonized criteria. Anneli will discuss this in more detail with you later today. A well-functioning, efficient bank crisis management framework is first and foremost necessary, of course, to ensure depositors' protection and financial stability in the banking union, preventing costs for the taxpayers. It minimizes value destruction as a mechanism that also helps the banking sector, therefore, to continue to support the real economy and remain resilient when it is hit by shocks. And to the extent that it provides solutions that are sufficiently predictable and compatible with level playing field, it also supports a greater integration of the European banking market. And we know how important it is to have private risk sharing to ensure the functioning of our monetary union. We need to keep in mind that it is possible to improve the crisis management framework to achieve these objectives in the current institutional setup, given the currently available crisis management resources and without any early commitment to go further, to do further steps towards integrating deposit insurance at the European level. The CMDI package, which is on the table today, which has been proposed by the Commission, serves this purpose and should be assessed exclusively on that basis. So let me start with the optionality point, which in my view is one of the most important. The proposal on the table would provide all relevant stakeholders with a robust toolkit, with a variety of tools and some discretion to choose the right one for each individual case. The Commission's text rightly opts for keeping all the tools available today as part of the framework, clarifying the conditions for their use and enhancing their effectiveness. Some tools, such as precautionary recapitalization, will continue to be used only in very rare circumstances and subject to strict conditionality. Others, such as deposit guarantee scheme, alternative and preventive measures, remain national in their application, but the rules governing their functioning are harmonized within the proposal, and with good reason for that. Also, the Commission proposal gives authority the necessary flexibility to choose the most appropriate and proportionate approach for each case. We should avoid prescribing a one-size-fits-all approach, as it is impossible to account for all the peculiarities of real-life bank failures. I mean, this is something we have seen again and again, and we should really learn from that. In short, to definitely deal with the crisis, we should avoid putting the crisis managers in a legal straitjacket. Instead, we need to provide a full toolkit to ensure optionality. This is the best way to reduce the cost of actual application. Second point, workable solution for mid-sized banks. We know that we have a remarkable diversity in our banking landscape. We have a wide range of banks, from large institutions active in international capital markets to cooperative networks or savings banks networks operating under the umbrella of institutional protection schemes, and medium-sized banks not covered by such schemes. And the latter type of banks under the resolution regime is subject to well-known challenges. In particular, their difficulty in raising sufficient loss-absorbing capacity can result in a shortfall in resolution funding and prevent these banks from accessing the SRF due to the 8% bail-in requirement. Dealing with these banks under piecemeal liquidation can also be suboptimal, as it generates significant value destruction, puts DGSs in their paybox function significantly under strain, opens up to highly non-harmonized national liquidation solutions, which in some cases may require the use of taxpayers' money. And all of this, unfortunately, has been observed in past experience. The Commission's proposals offer a sensible, clear and pragmatic answer to this problem. In a nutshell, the idea is to expand the resolution tools to also cover for medium-sized banks, and this would allow the use of best practices, sale of business tools for these banks. Transfer strategies have a proven track record of preserving value for depositors, unlike piecemeal liquidation, and generate broader financial stability benefits in the process. It will be important to find the right balance when casting the net of resolution wider. The ECB supports a proportionate expansion of the scope of resolution, as this will improve the effective and harmonized management of failures of mid-sized banks. Indeed, as the United States found out in the spring this year, medium-sized banks may appear non-systemic in life, but may then prove to be systemic in death. At the same time, it is important to assure sufficient proportionality and discretion and not overburden smaller banks, which may not actually be systemically relevant, even in death. I understand this topic has raised some concerns about a blanket expansion of resolution to all banks. This is not and cannot be the intention. Some further fine-tuning of the proposed changes to the public interest assessment may therefore be considered in order to address these concerns. At the same time, it is also important to keep in mind the safeguards that are already in the Commission proposals. After all, national resolution authorities would remain in charge of the public interest assessment for smaller banks that are outside the scope of the SRB's direct responsibility, and importantly, the responsibilities and tasks would continue to be shared between the European and national levels, as is the case today. Finally, on funding. The proposal on the table seeks to make the resolution tools fully operational by ensuring they are backed by funding resources that can be actually accessed and used. Indeed, there is no point in providing authorities with an ambitious toolkit and large amount of resources if access to the latter is subject to excessive constraints in practice. As I mentioned, we should remember that the EU has roughly as much industry-funded firepower as the United States. However, we are much more constrained in the way we can deploy those funds, meaning that we get much less bang for the buck, if I may say so, than our US colleagues. By allowing national DGS funds to be used to unlock SRF funding, CMDI could go a long way towards addressing this inefficient state of affairs. The three main elements in the package form a cohesive whole, and in my view, they cannot and should not be separated. Expanding the scope of resolution, as just discussed, the so-called DGS bridge, that is allowing the contribution from DGS to count towards the 8% threshold for the access to the SRF, and introducing a single-tier depositor preference. Taken together, these three elements would be really effective in equipping the authorities with credible options for the resolution of medium-sized banks by providing access to industry funding safety net in order to support best practice transfer strategies in resolution, such as the best, let's say, the well-tried and tested purchase and assumption strategy, which are used profusely by the FDIC in the US. We should thus resist the temptation to pick and choose certain parts of the proposal while discarding others, and as this would undermine the consistency of the overall package. Put simply, while the MREL requirements remain the first line of defense, we cannot credibly expand the scope of resolution without also facilitating access to funding for those banks that are predominantly deposit financed. And to close the funding gap, the DGS bridge and the single-tier depositor preference are key. I've spoken mostly about funding and resolution, but it is also necessary to ensure funding in other non-resolution scenarios. Here too, the Commission's package, and in particular the single-tier depositor preference, will help to ensure that the funding equation adds up. Anneli will elaborate further on this later on. The discussions on CMDI have stirred controversy as to how to treat uninsured depositors. What is clear to both the SSM and the SRB is that there should be no blanket extension of the DGS coverage to all uninsured depositors, and this is indeed not foreseen in the CMDI package. Conversely, in some occasions, bailing in uncovered depositors can fuel financial instability, and the Commission has rightly chosen a middle ground, allowing resolution authorities to exclude uncovered depositors from bail-in when warranted by financial stability considerations. So let me conclude. The CMDI proposal provides the ECB with more tools in the run-up to a resolution, and the SRB and national resolution authorities with more options during the crucial hours of the resolution weekend. It also improves the framework for dealing with crises affecting medium-sized banks. The timely adoption of this proposal will be good for depositors and taxpayers, as well as financial stability. And we would like to see the co-legislators make swift progress in these regards. I hope today's discussion will help build a consensus over these important changes to the CMDI package, that the CMDI package is in store for our crisis management framework, and clear up some misunderstandings about certain features of the proposal. Of course, looking beyond the CMDI, some fundamental aspects of the broader crisis management architecture are not tackled by the proposal, and namely the adoption of the third pillar, the EDIS, the European Deposit Insurance Scheme, and the creation of a European framework for liquidity and resolution, and we hope that these aspects will be addressed in the next legislative term. Thanks a lot. Thank you.
Thank you very much, Andrea, for this great opening. Now we start with a keynote speech from the ideal person to set the scene for our discussions today, Sean Berrigan, Director General for Financial Services, Financial Stability and Capital Markets Union, otherwise known as DG FISMA, of course, at the European Commission here in Brussels. Please.
Thank you. Good morning to all here in the SRB premises and to all of those hundreds, I believe, are online. I want to thank Susan, first of all, for introduction, and also thank Dominique and Andrea for the invitation to come here today. I think it's an important seminar because it's a key topic of relevance to the EU banking sector. I think the seminar brings together, I think, many of the key partners in operating the EU bank resolution framework to discuss the Commission's most recent proposal for reform. And this, of course, as has been outlined by Andrea, is the Crisis Management and Deposit Insurance, or CMDI proposal, just another acronym to add to the many acronyms that we have. I should acknowledge up front that the SRB and the SSM have cooperated closely in preparing this proposal, and we in the Commission are very grateful for that cooperation. And beyond that, we have consulted stakeholders extensively when drafting the proposal, and hopefully we have addressed most of the concerns expressed in those consultations, although I'm pretty certain we have not addressed all of them. Now, Andrea has outlined the main rationale and features of the proposal. Actually, I just noted he outlined them better than I do, so I'm even more convinced than I was when I came into the room that this is a good proposal. So there's no need for me to repeat, but maybe to make some more general remarks. But most of all today, I think, is an opportunity to discuss what you here in the seminar think works well and maybe not quite so well in our proposal. And in fact, I feel a bit like a student here waiting for his homework to be marked. I won't be here, but I have others who'll be here to hear what is said. I want to say a few words of background to the proposal. I think, as Andrea was mentioning, the EU banking sector has come a long way since the global financial crisis in 2008-9. Banks are much stronger and more resilient, and this was evident in the recent EBA SSM stress tests. And this is, to a very large extent, due to the extensive reform of the EU regulatory framework for prudential oversight and crisis management. And it's also due to profound changes in the institutional architecture of the banking union, reflected not least in the fact that this seminar is being co-hosted by two of the institutions created for the banking union, SRB and SSM. And all of these improvements allow us to prevent and manage bank crises much more effectively than 15 years ago. So we have a lot to be satisfied about. But if we have a lot to be satisfied about, why did we put forward the CMDI proposal? Well, we certainly didn't do it for the enjoyment. As my team and others in the room will be happy to tell you, progress in completing banking union is hard-earned. You don't do it for the fun. And we propose the CMDI reform because, our resolution framework, I think, works well in theory, but much less so in practice. Actual experience since 2015 has revealed shortcomings mentioned by Andrea, but as a reflection of those shortcomings, I think a pervasive reluctance to use the resolution framework as it now stands. We have only used it really once in all that time. We may have just been lucky, but maybe not. So we needed to understand why this is the case and adjust the framework accordingly, all the time without throwing out the baby with the bathwater. So in that sense, I want to be clear today that we see the CMDI proposal as an evolution, not a revolution in the existing framework. Some significant adjustments are proposed, but none of the fundamentals are compromised. More importantly, and perhaps most importantly, the two fundamental objectives of what we might now call the post-Great Financial Crisis resolution doctrine, that is safeguarding financial stability and protecting taxpayers, are fully preserved. In fact, we believe this proposal reinforces them. Now, the proposal has been under preparation for many years as one of the 4 pillars of the so-called banking union roadmap. It is somewhat different from the other pillars insofar as it's less about creating something new in banking union and more about reinforcing an existing element of banking union. On the other hand, it is very similar to the other pillars in its technical complexity and political sensitivity. It may have looked oven-ready when adopted, but I can assure you that a great deal of mixing and remixing of ingredients went on in the years beforehand. And here I want to take this opportunity, and I don't have many, but I take this opportunity to pay tribute publicly to my great CMDI team, some of whom are here today, past and present, for all the blood, sweat and tears that have gone into this proposal. At a more political level, the proposal has been, and I use my words carefully, they have been informed by deliberations in the Eurogroup and the now famous, at least famous in our little bubble, statement of July 2022. Now that statement, which reflects a finely balanced compromise between national interests, is perhaps inevitably not always crystal clear. But the Commission was always crystal clear that we would produce a CMDI proposal that was both ambitious and internally coherent. And I hope that you can all agree that at least we have done that. Now, adoption of the CMDI proposal by the College in April coincided with the failures of several banks in the United States and of a globally systemic bank in Switzerland. Now, these events have given rise to many, lessons to be learned discussions about the implementation of international standards on banking regulation, supervision, and crisis management after the great financial crisis. Now, our proposal was certainly not meant as a response to those lessons learned. But these most recent bank failures were, I think, a timely reminder of a much more general lesson learned since the great financial crisis. And that is that we must have in place the most effective possible arrangements to deal with all troubled banks, whatever their size and whatever their circumstances. Here in the EU, we have too often seen the failures of medium-sized and smaller banks being managed outside the harmonised resolution framework, and often by using taxpayers' money instead of banks' loss absorption capacity and industry-funded safety nets. The CMDI proposal, as we put it forward, aims to address this phenomenon by along three main axes. We first want to ensure that more banks can be resolved via appropriate use of the public interest assessment. But as Andrea has said, this certainly does not mean that all banks must or will be resolved. It is not a blanket expansion, as Andrea has said. Providing resolution authorities is the second pillar, is to provide resolution authorities with the necessary discretion and the right set of tools to handle the full spectrum of banks if they are failing or likely to fail. And then lastly, we want to make adequate funding available to ensure that these tools can be applied credibly to any bank, where, based on a least cost analysis, resolution protects financial stability, depositor confidence, and taxpayers' money better than liquidation. Now, the proposal is a coherent whole, so we see all the elements as equally important. But there's no doubt that the funding aspects are the most controversial, and so they are the subject of particular attention in the co-legislation process. Controversial or not, we must get these funding aspects right. Without appropriate funding possibilities, the other elements of the proposal will not have the desired effect. Indeed, an extension of resolution to more banks without appropriate funding could make the current problems with the framework even more difficult. So I just maybe say a few words specifically on these funding aspects of the proposal. Incentives to use resolution have often been distorted because of the difficulties in bailing in uncovered depositors when this would be needed to access resolution funds. Why? Because imposing losses on such depositors, even the prospect of imposing such losses, comes with a high risk of undermining depositor confidence and threatening financial stability through contagion risks. This tension, I think, was again evident in the bank crisis earlier this year, in the US in particular. Banks' internal resources, that's MREL, should of course remain the first line of defence. Shareholders and creditors should be the first one to absorb losses in a failing bank. No dispute there. But we also need to be prepared for tail events, when bailing in shareholders and creditors may turn out to be insufficient to fund a successful resolution, while liquidation of the bank would be more costly and disruptive. And this is why the CMDI proposal allows deposit guarantee schemes to contribute to the funding needed to transfer all deposits, insured as well as uninsured, from a failing bank to a third party or a bridge bank. This bridge mechanism can be a more efficient and cheaper way to deal with the bank crisis and protect depositors, instead of paying them after the bank has failed. But let me stress, the use of the bridge would come with safeguards. For instance, this bridge mechanism would only be applicable for banks whose resolution will lead to an exit of the market. It will not be used when banks are restructured in resolution. And let us all recall that resolution authorities will keep the possibility, if they deem it appropriate, to impose losses on uncovered deposits. So ultimately the question is, who should pay when the bank fails and all the available loss-absorbing resources have been exhausted? Should it be taxpayers? We think not. Should it be depositors? Experience suggests resolution authorities often think not. What's left is therefore the industry safety nets. One thing is clear, as I said, taxpayers should not be on the hook anymore. And depending on the circumstances, bailing in uncovered depositors may or may not be appropriate. If this is the case, we need to ensure that the EU authorities have the necessary flexibility to use industry-funded safety nets to deal with such cases. This may be the most cost-effective way to handle a crisis, preserving value instead of destroying it, and using deposit guarantee schemes in a way that depletes them least. And this is precisely what the funding aspects of the CMDI proposal imply. The aim is to enhance the use of industry-funded safety nets, so as to shield depositors from losses where needed, and as a complement to solid internal loss-absorbing capacities that remain the first line of defence. So I repeat what I said earlier, none of the fundamentals of the resolution framework have been compromised here. So before I conclude, maybe just say a few words where we are in the co-legislation process. We have draft reports on each of the proposals that make up the CMDI package, and there are several. They've recently been published by the respective rapporteur in the European Parliament. And the Council is also making pretty good progress under the Spanish presidency. We in the Commission are, of course, supporting the co-legislators in their work, and we look forward to the finalisation of their mandates in the coming months and then the start of the trialogues proper. With this proposal, I think we are moving a step closer to achieving our long-term goal of completing the banking union. I'm hopeful that once agreement on the package has been reached in co-legislation, it will, as Andrea has hoped also, I think, pave the way for creation of the European Deposit Insurance Scheme and for a facility for liquidity in resolution, and help us provide an even more secure, efficient and stable banking market for the EU and its citizens. But today, I'm afraid, it's not about hoping. Today is about discussing what's on the table as it stands, and that's about the CMDI proposal. And I wish you all a very interesting and successful seminar. Thank you all very much for your attention.
Thank you very much, Sean, for sharing your thoughts on your recipe for improving the banking union, which I note includes also blood, sweat and tears. Many of the topics you raised will be discussed later in the panel discussion. So thank you very much for taking the time to be with us when I know it's a very busy day. Thank you. Now let's take a deeper dive into the key changes that CMDI brings and their impact. Anneli Tuominen, member of the Supervisory Board of the European Central Bank, is going to start us off with the pre-resolution impact of CMDI, followed by SRB Board member Sebastiano Laviola on the impact of the proposed changes when a bank is actually in resolution. We'll have some time at the end to take questions to both speakers, so to the almost 600 of you online, please don't feel free to pop them into the WebEx chat. Annalie, over to you, please.
Thank you so much, and thank you to the Single Resolution Board for hosting this extremely important event. And hopefully there are no blood, sweat and tears today during this seminar. Anyway, let me start by stressing the significance, both for the ECB and the banking union as a whole, of the current review of the EU's crisis management and deposit insurance framework. Indeed, the market turmoil following events in the United States and Switzerland this spring served as another reminder of the importance of having a proper crisis management framework in place. Within the banking union, we have already made substantial progress on crisis management. At the same time, we have learned valuable lessons from the experience of the past decade, standing us in good stead to further improve the framework. And this time is of the essence, as at this critical phase of the legislative process, especially with the end of the legislative tenure fast approaching. I will first highlight some relevant supervisory aspects of the European Commission CMDI package. I will then focus on how deposit guarantee schemes could provide a wider range of crisis management options to address possible or actual failures of banks of all sizes in a more cost-efficient way. These were already referred to in earlier interventions. As the European banking supervisor, the ECB plays a central role in crisis management within the European banking system, working closely with all relevant stakeholders, including the SRB, the Commission, and the national supervisory and resolution authorities. As part of our ongoing supervision, we assess banks' recovery plans, which serve as an important crisis prevention tool. When a bank does not meet or is unlikely to meet its supervisory requirements, we are also empowered to take supervisory and early intervention measures aimed at keeping it viable and preserving financial stability. In that regard, we welcome the Commission's proposal to enhance the early intervention framework, which is an important step towards addressing the practical challenges that we have faced in applying it. There are three main problems with the early intervention framework as it currently stands. The Commission's proposal provides adequate solutions to these problems. First, the proposal removes the overlap between early intervention measures and other supervisory measures and aligns the conditions for applying them, both of which are very welcome changes. Second, it includes the power to adopt all early intervention measures under a single provision, subject to the same conditions, without including an escalation ladder. This removes the sequencing problem that we face under the current regime. And third, the proposal provides a direct legal basis for the ECB's exercise and early intervention measures. These changes will help us to swiftly adopt the necessary and most appropriate measure for any given situation, and therefore we wholeheartedly support them. The CMDI package also improves the framework for collaboration and exchange of information between supervisors and resolution authorities. The ECB and the SRB already cooperate very closely indeed and exchange information based on a bilateral memorandum of understanding. The ECB supports the proposals to further enhance this cooperation and information exchange between supervisory and resolution authorities. The draft text also includes the proposal for a new early warning procedure, which would be activated when supervisors see a material risk that one or more of the conditions for an institution to be considered failing or likely to fail would be met. In such cases, our close cooperation would become even closer. Importantly, the new procedure will stimulate further dialogue about alternative solutions and their potential impact on the SRB's resolution preparations. It is, however, important that this new early warning process does not affect the well-established resolution procedure. Moreover, to maintain the necessary supervisory flexibility, the process should not become a precondition for a bank to be assessed as failing or likely to fail. For example, in fast evolving crises, we may have to jump straight to such an assessment without first being able to issue an early warning. We will involve the SRB and other stakeholders immediately in such situations. That goes without saying. Let me now move to my next point. Need to ensure that we have a wide range of options available to us in crisis situations. Crisis management needs to be understood as a continuum. As part of our day-to-day supervision, we help banks strengthen their resilience to all kinds of risks. However, the specific circumstances leading to difficulties may still be unexpected, for example, with respect to a bank's capital and or liquidity position, as was the case with Sberbank, which suffered a deterioration in its liquidity position as a result of the reputational impact of geopolitical tensions. From a banking supervision perspective, it is indispensable to have a broad toolkit and a certain degree of flexibility in such situations, ideally within a fully harmonized crisis management framework. Equally, it's important to have confidence that there are sufficient options to resolve the situations of banks in distressed conditions, even those assessed as failing swiftly and effectively. Although the EU's crisis management framework is well established, experience has shown that improvements need to be made, particularly with regard to medium-sized banks. It can be very difficult to apply resolution tools to some of these banks, especially those that are primarily financed with deposits, without causing losses for deposits that are not protected by ADGS. Imposing such losses on deposits can cause contagion effects and affects financial stability, exacerbating the risk of broader bank runs. That was also mentioned earlier today. In turn, this may lead to serious adverse effects on the real economy. Such effects should be considered on a case-by-case basis, having regard to the specific details of the crisis situation before deciding how to address it. In this context, stakeholders other than the supervisory and resolution authorities can and will have to play an important role in crisis management. The CMDI proposal therefore further calibrates some of the existing tools that are available to such stakeholders, including DGSs and precautionary recapitalizations. In line with our stance on ensuring adequate optionality for decision makers in crisis management, we do welcome the fact that these other tools are retained and further elaborated in the Commission's proposal. Having more options may open the door to cheaper solutions and thus a more efficient use of limited resources. Before going into more detail on the role of the GSEs in crisis management, I would like to say a few words on precautionary recapitalization. We consider precautionary recapitalization to be an exceptional but useful tool within the current crisis management framework, albeit one reserved for extraordinary circumstances. It is and should remain subject to strict conditions. Past experience and the limited use of the instrument thus far indeed indicate that the current conditionality is appropriate. We therefore welcome the clarifications included in the Commission's proposal that support a quick and effective implementation of the tool in very exceptional cases. At the same time, the ability of the relevant authorities to take the specific circumstances of each case into account should not be further constrained. For example, setting a fixed timeline for exit strategy or linking possible delays to an automatic assessment of failing or likely to fail may limit the scope for taking into account unexpected developments. Let me now focus on another possible avenue for expanding our range of crisis management options, which is the use of DCSs. We can all agree that DCSs are essential to mitigate the risk of bank runs and are thus also key for ensuring financial stability. In some countries, their role is narrowly circumscribed to being that of a paybox, with the sole ability to compensate covered deposits through ex-ante payouts and then collect the proceeds during insolvency. But there may be other ways in which they can help to achieve financial stability objectives and avoid bank runs than through this liquidity-intensive paybox function. In fact, in its 2021 annual survey, the International Association of Deposit Insurers reported that 80% of its member DCSs had the power to use their funds for purposes other than payouts. The international trend points towards a growing role for DCSs going beyond a mere paybox function. Many countries, including outside Europe, have found it worthwhile to be more flexible when it comes to the role of their DCSs. Aside from their payout function, DCSs can be enabled to act at various stages during the crisis management continuum. They can broaden optionality pre-resolution by expanding the toolkit available to prevent a crisis in the form of what I will call DCS preventive measures. They can also broaden optionality in liquidation, which I will refer to as DCS alternative measures. Finally, they can be used to further enhance the operationalization of resolution tools, by which I mean that they can help fund resolution actions, in particular transfer strategies. I will now zoom in on those three areas. So, DCS preventive measures can be a useful crisis prevention tool. They can help banks to ensure or restore compliance with the prudential requirements in going concern situations. However, financing such measures could mean another burden on the DCS and might be perceived as a rescue measure, thereby undermining market discipline. The proposed legislative package seeks to put in place adequate safeguards to ensure that the use of these measures is adequately safeguarded and timely. So neither too late nor too early. There are also safeguards to ensure that these measures are cost-effective and applied consistently across member states. However, under the proposal, DCS finance preventive interventions are still just an option for member states. Although we fully acknowledge the related challenges, we encourage legislators to further harmonization and ensure a level playing field by making these preventive measures available across the EU. The second area concerns DCS alternative measures. Even with a broader scope of resolution, a significant number of small banks are likely to remain outside the scope of resolution. Applying the resolution framework to these banks would simply not be proportionate. In these cases, DCS alternative measures can be a useful tool in liquidation, as they may facilitate transfers of assets and liabilities to an acquiring bank. Let me briefly explain why such transfers can be such a useful option in the toolkit and why they are being used extensively in key non-EU countries. First, they can improve value recovery, which is a critical objective when dealing with a failing bank. Second, they can reduce strains on DGS liquidity by avoiding payouts. Third, they can improve depositor protection by preserving an uninterrupted access to depositors to their funds and by often allowing to broaden the scope of depositor protection beyond covered deposits. This is becoming more and more important as depositors turn to digital means of payment instead of cash. Finally, by making it possible to address bank failures in a much less disruptive way, they support financial stability and minimize the need for government support. I would like to focus on the first 2 points in a little more detail. Why are transfers often better able to preserve value? Some seem to think that a quick transfer is basically a fire sale. That is a misconception. In the US system, a transfer is typically the result of weeks of due diligence by acquiring bank, which can then benefit from the franchise value of the failed bank, its customer relationship, its staff, and its deposit base. Transferring the whole bank also minimizes administrative costs by avoiding a drawn-out liquidation process. This was the case with Banco Popular. Had the bank been liquidated, the losses to shareholders and creditors would have been 2 to 3 times higher than they were after the transfer in resolution. By avoiding a payout, alternative measures can also limit liquidity strains on DGSs. Payouts can be a heavy burden for DGSs, even in the case of smaller banks. As a recent ECB occasional paper shows, in each member state in the banking union, there is at least one less significant bank that could deplete its fully filled DGS with a single payout. In most member states, there are several. In normal times, DGSs can obviously refund themselves, but this comes at a cost. In periods of systemic stress, several smaller banks may fail in one country, subjecting the DGS to greater liquidity stress at a time when refunding could be more expensive. Some countries counter this by citing their positive experience of quickly recovering DGS funds. But we should be mindful that even in a best case scenario, where a DGS is fully repaid within a few years, the actual payout ties up significant resources and at considerable cost, especially in an environment of higher interest rates like the one we are currently facing. There are significant opportunity costs associated with payouts. Simply put, in crisis management, time is money, and transfer strategies, by virtue of being a lot more time efficient than payouts, can entail significant savings. So, alternative measures can serve to contain DGS's upfront outlays, administrative costs, and the loss of asset value caused by winding up process. They can improve depositor protection and help to safeguard financial stability. We therefore think it would be useful to make DGS alternative measures in liquidation available across all member states in a harmonized way. And then the third area where DGSs can play a valuable role is in helping to provide funding in resolution. As the chair of the supervisory board, Andrea Enria, said earlier, ensuring adequate funding in resolution is an important precondition for the proposed expansion of resolution to medium-sized banks. We welcome that the CMDI proposal facilitates an enhanced application of transfer tools in resolution, supported by DGS interventions where needed. The contribution from the DGS will count towards the minimum loss absorption requirement to access the Single Resolution Fund, namely 8% of total liabilities and own funds. This DGS bridge mechanism will thus ensure that a larger number of medium-sized banks can potentially access the SRF. We also welcome that the proposed legislative package includes options for the DGS in the context of the bridge mechanism to protect non-covered depositors when needed. The DGS bridge comes with a lot of strings attached, which we fully support. To use an analogy, think of it as a narrow footbridge with selective entry criteria rather than a Golden Gate style road bridge accessible to all. You would only walk the footbridge if there was no way to avoid it. The DGS bridge is limited to banks earmarked for resolution, to transfer strategies leading to market exit, and to the amount necessary to meet the 8% TLOF requirement to access the SRF. This conditionality is crucial, as it means that any possible DGS support only forms a second line of defense and, importantly, will always lead the failing bank to exit the market. The cardinal principle that losses in a credit institution failures to be borne first and foremost by shareholders and creditors also applies in these cases, and rightly so. Medium-sized banks earmarked for resolution will be required to have a minimum loss absorption capacity as a first line of defense adequately calibrated in line with the resolution strategy, thereby ensuring market discipline and minimizing reliance on external funding sources. This is an important safeguard as resolution authorities will continuously assess banks' resolvability and their compliance with the minimum requirement for own funds and eligible liabilities. The new REL disclosure requirements will also help to support market discipline and REL compliance. For non-covered deposits, resolution authorities must also demonstrate that the reasons for their protection are met. Therefore, it will not be automatic. These new DGS interventions will only be possible if the protection of non-covered deposits is fully justified. Of course, we at the ECB are aware of the concerns expressed about a greater recourse to DGS funds. These concerns are understandable, especially as the fundamental role of a DGS is to prevent bank runs and support financial stability. However, we also need to be mindful of the important benefits that a transfer strategy can bring in this regard. And we should not forget that the Commission's proposal includes a range of safeguards. One key safeguard is the least cost test. The amount of DGS contributions in resolution and in preventive and alternative measures is always limited by this least cost test. It compares the cost of a DGS intervention to prevent a bank's financial situation deteriorating further, or the cost to the DGS of transferring business to another bank with the hypothetical cost of paying out covered deposits in the event of liquidation. We welcome the intention to further harmonize this least cost test. In terms of governance, the DGS remains responsible for performing the least cost test and assessing the possible DGS resources, which are also capped by the amount of covered deposits held at the respective credit institution. We also welcome that the European Banking Authority will be mandated to develop draft regulatory technical standards specifying the methodology for the least cost test calculation. The approach to calculating costs will be a sensitive topic and an important factor influencing the scope of DGS funding available for non-payout measures. According to a study by the Bank for International Settlements, the elements taken into account when calculating the cost of payout vary significantly across jurisdictions. The creditor hierarchy is another key factor in estimating the cost of DGS payout and thus the outcome of the least cost test and the DGS funds available. The higher the DGS claims rank in the creditor hierarchy, the less likely it is that the least cost test will authorize preventive or alternative DGS measures or pay DGS contribution in resolution. The current super preferred ranking of DGS claims greatly limits the availability of DGS funds for measures other than payouts in Europe. Therefore, the Commission's CMDI proposal seeks to introduce a single-tier deposit preference, meaning that all deposits rank the same and above ordinary unsecured claims. In addition to improved access to DGS funding and measures, the proposal will also further harmonize the creditor hierarchy across the EU. Sebastiano Laviola, member of the Single Resolution Board, will shortly be presenting an analysis by the SRB of the different benefits and implications of the proposal. But it is important to keep in mind that the single-tier deposit preference and the DGS bridge are closely interdependent. In short, without changes to the creditor hierarchy, the DGS bridge risks becoming a bridge to nowhere. Conclusion. To conclude, this review is an important opportunity to further enhance the existing EU crisis management framework using the lessons learned during the first years of its applications. Changes envisaged during the legislative process need to consider that the key elements of the Commission's proposal together form a cohesive whole. Any changes should not alter the existing balance. They should enable existing industry-funded safety nets like the Single Resolution Fund and National Deposit Guarantee Schemes to be used more efficiently in order to support financial stability, enhance depositor protection, and provide more options for crisis management, not forgetting the necessary safeguards at the same time. A swift legislative process is of the essence, as the CMDI package is a crucial intermediate step towards a more resilient and more integrated European banking sector, benefiting the European citizens. I therefore greatly appreciate the strong support and commitment shown by all legislative bodies for an enhanced CMDI framework. Thank you very much.
Thank you very much, Annalie, for this very comprehensive presentation, which I think leads nicely now to Sebastiano, please.
Thank you very much, and good morning, everybody. And so the goal of this presentation, after all the policy goals and potential benefits of the reform that we have just heard, are from the three previous speakers, are essentially the following. So all the attention concentrated essentially on what Sean Berrigan called the funding equation. So let's understand with more updated information with respect to also what the Commission has already done, what would be the impact on the DGSs of the various countries if called to be used to essentially reach the 8% TLOF in case of resolution, and then what would be the impact on the Single Resolution Fund? Because there was a lot of, we sense, at least we had a lot of worryings about that and about bailing out banks or statements similar to those. First of all, these are all industry funding funds, and therefore this is important to take in mind. So here, the two goals are here. We wanted to assess the impact of the use of the DGS in resolution and of the single tier of general depositor preference on the DGS and the impact on the single resolution fund, as compared, of course, to what we have today, which is a different creditor hierarchy. For which banks? The banks already earmarked for resolution, and the focus is always on eventual deposits that are in either in the MREL capacity, low amount, but they can be in the bail-inable liabilities, of course, or for banks that could change strategy from liquidation to resolution. And then we wanted also to assess the effects of the single-tier depositor preference on the costs of the DGS for the banks, the vast majority, the very big majority of banks that will in any case remain earmarked for liquidation because they are not deemed to have systemic impacts and financial stability effects, because clearly with the change from the multiple tier or super depositor preference to the single tier, the DGS ranks pari passu in the liquidation, and therefore it will be reimbursed pari passu with the uncovered depositors, because it has substituted to the covered depositors in the reimbursement. There are a few assumptions which we deem reasonable for this study. And what are the assumptions? We assume the capital is depleted at least to taking out all the buffers, including the capital conservation buffers. Consider that for certain size of banks, smaller banks, the minimum capital requirements are substantially higher. So the capital requirements are substantially higher than the minimum, and these are all buffers, and therefore they are all depleted. Then we took into consideration a net recovery for the assets of 85%. Why this number? It is the same used in the EBA study and in the Commission impact assessment. The single tier depositor preference, and this is as I said, here we want you to go in the worst case for the sample of banks assessed. All deposits are excluded from loss absorption. This is by no means the goal of the Commission proposal. It has to be a case-by-case assumption, but in order to assess what could be the potential impact. That is why we took all deposits excluded from the loss absorption, also because this is a statistical assessment, and therefore we are not going to target this or that bank, and we know that crises are very specific. The reference date is end of 22, and which are the banks in scope? The bank in scope, we took all the SRB banks, excluding the host banks. So there are 204, including the LSIs, and they are distinguished for today being earmarked for resolution and liquidation. In the end, you see that for liquidation banks, this is an important assumption that under the SRB, we have overall 14 liquidation banks, or banks earmarked for liquidation, of which 9 are considered. Why the other 5 are excluded? Because these are banks earmarked for simplified obligation, or they have a specific business model. Mostly they are promotional banks. In some cases, don't collect deposits. Therefore, by definition, are outside of the scopes. For LSIs, the assumption is important and to be kept in mind that we exclude all the banks under simplified obligation. Now, these are particular type of banks that, because of their as contemplated in the BRD and in the delegated regulation, they have a special regime in terms of frequency of and content of presenting the resolution plans, and therefore also the data, to have access to this data is not easy, because they don't produce resolution plans every year. and according to the measures of the thresholds that are established in the delegated regulation, they can be classified under simplified obligation, and therefore they are banks that normally do not have systemic impacts, and they are very low size. And on top of that, one has to consider that almost 80% are members of APSs, and around 90%, as I said, have total assets below 5 billion. So this is the banks which we are left in the scope of the exercise. I have to say that the liquidation LSIs, excluding the banks under simplified obligation, would be about 70-75, but for certain banks the data were not the required quality, and therefore they were excluded from the analysis. But in principle, they would be included if one should see whether they qualify for turning to a PIA positive rather than negative, as it is today. Now, it is also important as an example, but this is again a worst-case scenario, that all resolution banks are considered in the analysis, so irrespective of the chosen resolution tools. We know that the proposed legislation envisages only banks earmarked for a resolution strategy, which is normally sale of business or a bridge bank accompanied by the other tools, etc. And the focus, again, is only on deposits, and this is the safeguard that is also in the legislation, in the proposed legislation, after that there has been the use of MREL, as Anne-Lee and Andrea and Sean Berrigan said. If we can move to the other slide. So how many banks are identified in the end? 47 banks already earmarked for resolution, divided in SIs and LSIs, would not reach 8% TLOF without bailing in deposits. And they are widespread in various member states of the banking union. The result is, clearly assuming the single-tier deposit of preference and the comparison with the least cost test, that the median gap to reach 8% is 2.4 for overall, but it is higher, clearly, because of the higher size for resolution banks. Now, let's go instead to the changes to the that the proposals provides in the PIA. Now, it is expanded, assumed to expand the scope of resolution, the proposals, or even though it is subject to discretion of resolution authorities, case by case, and in order to assess from the outside what could be the banks that could change the PIA. Now, we have taken into consideration these conditions. As to say, the banks where depositors, all depositors, would suffer losses in liquidation, and at the same time, the cost for the DGS would be lower in resolution than in liquidation. And this would have the resolution objective of the depositor protection at risk and thereby a positive PIA. Then there is also the other condition of critical functions. And here we proxy that with a high share of deposits or loans in a given region. We took the Eurostat classifications here for all the banking union countries, not clearly only at national level, and this would have critical functions at regional level at risk, and thereby a positive PIA. I have to say that the few banks selected are already included in the previous bullet. So in this case, there is no impact. The banks under simplified obligation would continue to have a negative PIA. So based on these assumptions, we have 26 banks out of the 62 of our exercise that could have their PIA change from negative to positive. But out of these 26, 19 would not reach the 8% TLOF without bailing in deposits. So these banks are in 12 member states of the banking union, as was the other case, where they are widespread, and the median gap is 2.2%. Now, let's go to the estimates of DGS use. So what is the real impact on the DGS of each and every country involved, assuming that, of course, there is an idiosyncratic failure, so not all together, but one by one. 36 banks out of 47 with a funding gap would have a positive risk cost test. This means that it is more convenient to bridge the gap to arrive to the 8% with respect to the paying depositors and then taking the proceed in liquidation with the single tier depositor preference. And this would enable the use of the DGS funds after use of the MREL. The impact on the median impact on the DGS contribution would be 15% of the available financial means. And here you have also a distribution where we have the original 36 banks and the 19 banks. So the further bullet points says that for the banks that would change peer, 26, we have 19 that would need funding, and this would have a positive risk cost test. I should add that if we do not have a single tier depositor preference, the vast majority of all these samples would not have a positive risk cost test, and therefore the DGS could not be able to intervene. Here, the median impact for the DGS is much smaller, 3.7, because the size of the banks is smaller. You could see that for the distribution, you see that the average, in all cases, is higher than the median. Why that? Because there are 2-3 outliers that impact the overall results. But clearly, in this case, this depends pretty much by the fact that in that particular country, for that particular bank, the amount of the capacity stored in the DGS has not even reached what they should reach according to the legislation, which, you know, had a transition period. The transition period has expired in July this year. Now, going to the SRF use, the SRF can only be accessed, as we know, after the 8% for the banks earmarked for resolution. Now, for the 36 banks that are already earmarked for resolution, the contribution for the median bank would be 1.6% of the current capacity. And in here, you see from the distribution that even if we took the tail of the distribution, the impact in billion would not represent more than 6% of the fund. For the 19 banks assumed to have a positive peer test, the impact is very minor because, as I said, the sizes of the banks are much lower. So here we calculated the two impact for DGS and for SRF. What comes out of this study overall? That seems to us that essentially all the impacts are very, very reasonable. And essentially, they confirm the view of expressed by the previous speakers and the goal, the rationale of the Commission proposals. That's to say that in order to expand the scope of banks in resolution, you need adequate funding. And therefore, this would happen case by case, but adequate funding is needed for the three elements that have been mentioned: DGS bridge, single tier, and more banks in resolution have to go all together, because otherwise, if one takes out one of the three, one would find itself, or the authorities would find themselves in a worse situation with respect to today. The other element of harmonization of risk cost test, in order to have consistency of its application across, at least in this case, the banking union, but across the European Union, according to the Commission proposal, is of course much welcome and needed. I would stop here. Thank you very much.
Thank you very much, Sebastiano, for this very detailed look at the impact. Now we're ready for some questions. I'm going to take the first one online and then come to you in the room. So it's a question for you, Sebastiano, I believe, but of course, Anneli, you're welcome to chime in. So the question is, will all the banks that pass the PIA or the PIT have to hold MREL? In particular, will smaller banks, for example, say the business banks, have to hold MREL in order to allow for the use of the DGS? And what about banks for which alternative measures are foreseen?
Sorry, I think that it was...
Let me say it again. Yeah. So will all banks which pass the PIA have to hold MREL? And the question is particularly related to smaller banks which might have sale of business or other transfer strategies. Will they have to hold MREL in order to allow the use of the DGS?
Yes, of course. I mean, once you turn a bank from liquidation to resolution, the MREL becomes from the minimum capital requirements, essentially the loss absorption capacity, to also adding the recapitalization amount. Now, according to our policy, in case of transfer strategy, there is a difference with respect to the full MREL that you have with the bail-in strategy, because you take into consideration that with reasonable estimation that the new bank, if it has a transfer tool, would have a different balance sheet and normally a lower balance sheet. That's why the recapitalization amount is smaller than in case of bail-in.
Of course, Dominique.
May I step in here? This is Dominique Laborex. Just to say that beyond MREL, there's this question of resolvability. Once we've earmarked a bank for a resolution, not only we ask it to build its MREL, but we also ask it to build its resolvability. And it's much more than MREL. It's about IT systems, it's about valuation capabilities, it's about, as we are targeting banks for transfer tools, ability to organize quickly, for instance, a virtual data room for auctioning the sale, etc., etc. So it doesn't stop at MREL. It's MREL plus all the elements of resolvability. So that means that I've read somewhere that there was a sort of free lunch for earmarking banks last minute for resolution. It cannot work like that. If we go for resolution, it means a lot, and that, by the way, all the banks earmarked for resolution know what it means in terms of preparation steps, including MREL, but not only.
Thank you very much, Dominique. A question for you, Anneli. Do you think that the CMDI proposals on the interaction between authorities before resolution improves the preparation? Does it imply less time to find other measures to prevent failure?
As I said, the cooperation between our authorities is already very good. And I see the proposal as a positive further step. And from that point of view, we are giving more information earlier to the SRB. But of course, I would like to emphasize that we, in our way of operating, we want to be open with the SRB because that is the way we manage to get to the best results. Thank you.
Thank you very much. Let's open the floor also to the room. Is anybody here like to ask a question to Anneli or Sebastiano? I don't see any hands raised, but we have plenty of questions online. So let me go to the next one. So the question is, the recent report from the FSB in regard to this year's banking failure seems to suggest issues surrounding the ability to bail in bonds held by US investors, issues under US law. So a question maybe to the SRB team, Sebastiano and Dominique, do you expect that to be a problem for future resolutions?
But look, the FSB report has a lot of, has highlighted a number of implementation issues while upholding the importance and the adequacy of the international framework. One of these concerns effectively the possibility to providing a higher assurance regarding the cross-border recognition and execution of bonds earmarked for bail-in and subscribed or issued in other countries, so subscribed by investors of another country or issued under the laws of this other country. Now, in the case that is treated there, which was Credit Suisse, in the end, through a lot of interaction among the authorities involved, it was possible to decide to qualify for an exemption of the bonds issued in the United States or subscribed by US investors, but this was pretty cumbersome in terms of all the time requested, as also declared by the Swiss authorities. Therefore, the lessons to be learned in that report is that, first of all, the preparedness of authorities and banks for the case, and this concerns essentially all the GSIBs, but not only, in case that there are bonds issued under the law of other countries, or in any case, like happened for international banks, subscribed by investors of other countries, to be sure that there is adequate understanding essentially of the securities laws that apply in those countries. And this is one thing, because in many cases it is possible to qualify for the exemption, but it is not a free lunch, just to be clear. One has to be very prepared about that. At the same time, and particularly in the case of the US, as it is mentioned in the report, the SEC is going to also help the other authorities in order to have a thorough understanding of its framework, particularly also as concerns the disclosure requirement that may be required according to the securities laws at the moment of resolution, immediately after resolution. So this is a work that will be done at international level. Thank you.
Thank you very much, Sebastiano. Of course, just a reminder to everyone, we are going to publish the slides and the speeches today on the various websites, so you will be able to have a close look at the figures afterwards. But another question about the liquidation banks that would be newly earmarked for resolution according to the SRB figures. What would be the total aggregated total assets, a ballpark figure, if you can?
I have to say, I didn't calculate the total aggregated assets. We can compute them, but certainly they are not a big amount, because the 26 banks of our sample and only 19 then would need funding, and most of them, so all of them essentially of these 19 are 18 LSIs. And therefore they are all below 30 billion. And I have to say, in many cases, they are, here I have the number. So you see, it is not even 7 billion of these 26 banks, the total assets of the bank.
Thank you very much, Sebastiano. Then we have a question related to the fund. So will the additional contributions mentioned to the Single Resolution Fund be realised by all the banks that have contributed to the fund, or just the new ones that become subject of resolution?
The contribution to the fund, well, I think the contribution to the fund, the answer is easy. According to the current legislation, it is mutualized, and therefore, clearly, it is a contribution from everybody. But as you have seen from the amounts, this is, with respect to the stock that we have, it is really, even if we take by chance, I undermine, the banks in the tail of the distribution, so the 99% percentile or the 100%, as I said, this amount would not be more than 5-6% of the total stock of the fund today. So if we have 78 billion, everybody can make the calculation.
Let me add something because we have received several times this question about who pays for the single resolution fund. So let me repeat what Sebastiano just said. Everybody pays, including those banks already earmarked for liquidation. So there is a complex formula, but everybody pays. And the reason is exactly because this single resolution fund participates in this global financial stability mechanisms with an S we want to implement in Europe. So that's why everybody pays, including those already targeted for liquidation. If they are targeted for resolution, they will continue to contribute to the single resolution fund.
Thank you very much. Let's give another opportunity to those in the room if anybody would like to ask a question. A bit shy in the room today, but I have another question from the chat. If it is so clear that there can be financing gaps for small and medium-sized banks up to failure, why not increase capital MREL requirements in the form of retained earnings and define an earlier point of intervention for these banks?
Look, this is a question both for resolution and for supervision, I would say. For sure, these banks, if they are turned out into resolution, they would have a full MREL according to the strategy. And normally, since they are mid-sized or small banks, I assume that they would have a transfer tool. So in any case, much more than today, because today they have only the minimum capital requirements. Then, of course, for the strategies that concerns the individual banks, we cannot have a say in that. But I would say that every bank that is turned into resolution, as Dominique says, has not only to increase the means to satisfy the MREL requirement, but also to have all the resolvability profiles that would be needed.
Okay, I mean, maybe also from the supervisory point of view, we have to stress that smaller banks in general, on average, are already facing higher capital requirements because their, let's say, balance sheet is less diversified, so they're already on the upper side. And if you compare, smaller banks in the European Union with smaller banks in the US, for instance, I mean, we are already applying the whole mambo jumbo of Basel standard, of international standards also to smaller banks. So capital requirements are already pretty conservative for our banks. So making them more conservative would be, I think, pretty complicated, while the solution which is put on the table by the Commission is much more proportionate and reasonable, I would say.
May I intervene also to add two things? Even if we decided to increase the capital requirements even more, or the MREL, etc., by retained earnings or whatever, it would not be made in 1 year. Don't forget that the building of the MREL targets, which is near to its completion, started 7 to 8 years ago for the significant institutions, plus the less significant institutions already earmarked for resolution. So it's not by changing the bar that it will give immediately additional resources. It will take time in any case. But a second element I would like to add, all the assumptions presented by Sebastiano are just assumptions. Nobody says that in all these cases we will have recourse to the DGS funding. In a number of cases, in reality, these LSIs targeted for resolution will have enough resources to, let's say, withstand the implementation of a resolution scheme without recourse to the DGS. All the proposal of CMDI is to be sure that if one of these banks is confronted to a situation which does not fill the gap to access the famous single resolution fund, then we can use another source of funding, which is a source of funding coming from the banks themselves. This is the aim, but that doesn't mean that it will be used in all cases, not at all. These are just assumptions.
Thank you very much. Maybe we're going to take the last question, but there are plenty of questions. What we will do is put them together afterwards and publish a Q&A, and we'll see also what we could take later in the panel. But for the last one, I think it's also a question for both supervisory and resolution authorities. What would you do if the banking crisis comes from liquidity issues or reputational issues, so no money is needed to absorb losses, and not from solvency issues? And how would CMDI help in that case?
Well, this is exactly, it is at the core of what we have seen in a recent crisis, that you have seen banks failing, unfortunately, because of idiosyncratic impacts, like the Sberbank, geopolitical tensions and uncertainty, and respecting the capital requirements. And also in the case of the American banks, it was a number of reasons why this happened, but the capital requirements were not, the issue. Because there were not many, losses coming from credit or other types. There were some unrealized losses regarding the securities that created, that were the trigger. But the capital requirements were, in principle, respected. Therefore, this means that in terms of tools, when you have, according to the scenario, different type of crises that do not necessarily depending from what we call a slow-burning solvency issue, you might want to use other tools or in combination to the bail-in other tools, which in this case are transfer tools. And therefore, as this Commission proposal, which was not, as Sean Berrigan said, driven by the recent market turmoil in March, in any case, envisage an important tool that can be used and facilitate the market exit in cases that are not that of fully fledged bail-in that can be applied.
In case you don't have a deterioration of assets and a lot of doubts on the actual value of the assets in the balance sheet of the banks, of course, the sale of business is much easier. So to some extent, the recourse to this type of tool is easier. And on the other hand, let me also say that there are a lot of things we have not discussed today, but which still are relevant in the proposal. If you think of the case of ABLV, we've seen a case of a bank that exactly went out of the market very fast because of the impact of, money laundering concerns raised by the US authorities. And in that case, the bank basically stayed in a limbo because the local courts did not accept the liquidation of the bank. So basically, we had the bank which was declared failing or likely to fail, and which stayed with the banking license for quite some time. So in terms of, there are a number of details in the current legislative proposals that would indeed address issues which could be raised in these type of cases. But indeed, I would say that also in cases in which the trigger is liquidity, when the trigger is liquidity and deposit outflows, as we have seen recently, the key problem is that the pace at which events occur. So having done preparation for all possible situations and having back in the sleeves, different options to deal with this crisis, I think make us much better prepared and much more effective in dealing also with these cases.
Any last word on that question? I don't think so. So let me thank all of our speakers this morning so far. We're now going to take a quick break. For those of you here in the room, please join us for a coffee outside. And those of you logged in, please take a break and have a drink of your choice. And we will see you back here at 11:15, where we're going to talk about a lot of the issues raised in the discussions this morning in our panel. So we'll see you very soon. Thank you.
Mrs. Isabelle Vaillant. May I ask you to test the microphone and the camera, please? Hello, Mrs. Vaillant. Could you please unmute your microphone and activate your camera? Okay, I can hear you. Thank you very much. Thank you very much. We can now see you and hear.
Welcome back, everyone. Hope you had a good break. After all the food for thought earlier, we have a very distinguished panel with us to tease out some of the issues raised. So I'm delighted to welcome Sofia Toscano Rico, Deputy Director General of Horizontal Line Supervision at the European Central Bank. Joining us online from Paris is Isabelle Vaillant, Director of Prudential Regulation and Supervisory Policy at the European Banking Authority. Martin Merlin, Director for Banking, Insurance and Financial Crime at the European Commission's DG FISMA. And joining us again is Sebastiano Laviola, our SRB board member. So let's get started. Martin, the first question is for you. Issues such as the scope of resolution and funding are the backbone of the reform, as mentioned this morning. Can you restate the Commission's intention in these areas, as well as run us through some of the other changes in the CMDI package?
Yes, thank you. Thank you very much. I should start by saying that we aimed at putting forward a coherent package spanning across quite a number of issues, but we thought that this was needed in order to propose something that is technically sound and that can really help us improving the system as a whole. The main purpose, as you know, is to improve the framework to deal with the failure of smaller and mid-sized banks, which nevertheless are too big to liquidate. So we want to make sure that we have a framework that works for all banks, irrespective of their size, of their business model, by using the bank's loss-absorbing capacity and industry safety nets, and avoiding using taxpayers' money. Importantly, resolution should remain a case-by-case decision, depending on the circumstances, which means that authorities need to have discretion in deciding whether or not a bank should be resolved. And we want to make sure that resolution authorities continue to have a broad set of tools available using resolution or other avenues. We nevertheless think that placing more mid-sized and smaller banks in resolution and transferring their business to a viable buyer should become a credible option. What we see now is that this option is sometimes disregarded, in our view, for the wrong reasons. So it's not all about resolution, but it is making sure that resolution becomes a credible option at the disposal of competent authorities. And that means, of course, making sure that funding in resolution is accessible. And this is, of course, a key point of the reform. And that is why we propose to unlock funding, notably from the industry safety nets, which were created precisely to protect financial stability, of course, after shareholders and creditors have suffered losses. So first, we want to make it possible to access DGS funds in resolution to help finance market exit via the transfer of the failed bank's business. And also, we think that where necessary, the DGS contribution could help access the resolution funds without imposing losses on depositors. And we think that this mechanism would only be available for banks that were previously earmarked for resolution. This is important, and also for banks that are going to exit the market. Clearly, MREL should remain the first line of defense, and therefore, by legislation and also thanks to the relevant authorities, we must continue to make sure that banks hold enough loss-absorbing capacity. As you know, to make all this work, the proposal modifies the hierarchy of claims to facilitate the fulfillment of the least cost test, to access, in certain circumstances, funds from the DGS. We think this is essential to enable accessing industry-funded safety nets and to finance transfer strategy. And more specifically, we propose a bridge mechanism contributing to the minimum bail-in condition of shareholders and creditors to unlock, in certain cases, the single resolution fund. That said, I want to stress as well that we want to make sure that the various optional crisis management tools that are available to competent authorities remain in place, meaning using DGS funds for preventative measures and alternative measures in insolvency. But for that, we harmonize the conditions for accessing funding through harmonization of the least cost test. So in a way, we want to make sure that the best tool is used in each circumstances based on case-by-case decisions. So resolution authorities should look at the merits of the tool only and not use a given tool because access to funding is easier for that tool than for others. So this is really, these are the core elements of the proposal, and I'll stop here.
Thank you very much, Martin, for that very comprehensive summary. Let's go to you, Sophia, and let's try to make this more concrete. Let's say the CMDI is in place and we have a bank failing in 2025. We can call it the Ramparts Bank after the 14th century city walls. You can see behind the speakers here. How would the CMDI proposal help you as a supervisor to avoid the failure, or how would it improve the process in the run-up to a resolution for our Ramparts Bank?
Thanks a lot, Susan, and good morning, everyone, from my side as well. So let's get a bit more concrete indeed. And from the supervisory side, well, we are monitoring the banks closely. We have what we call an emergency action plan framework. So we have an internal framework that allows us to monitor banks that are entering into more difficult situation. How the CMDI would allow us to improve the way we are looking into this. First of all, and Annalie mentioned it in her intervention, the review improves the existing early intervention framework. It makes a direct legal basis for the ECB to intervene, so we are not so much dependent on the national transposition of the framework that from previous experience shows that it can differ. So we will have now a legal basis for direct intervention from the ECB side. But furthermore, it will remove existing overlaps between early intervention measures and supervisory measures, which will allow us also to apply these measures more forcefully and without having to measure and to have a kind of an escalation ladder process in place. Because the crisis, as we have also already mentioned, can evolve in very different ways. And it could be slow burning crisis where we have time to go step by step taking different actions, but it could also be very fast moving crisis where we need to take the right measure in a timely manner. So the fact that there is this removal of the overlaps and that there is a single provision now, there would be a single provision now for early intervention measures that subjects all the measures to the same conditions, will allow us to have more optionality and to choose the right measure to take even in still in a going concern way. But of course, things may go worse and the bank can continue deteriorating. And therefore, another thing where the proposal will help is that it increases and ensures optionality in the crisis management framework still in a pre-resolution phase. So in our view, it's critical that the CMDI proposal maintains and further harmonizes existing pre-resolution tools from the different stakeholders, like allowing and strengthening the possibility of DGSs to intervene with preventive measures, but also the possibility of precautionary recapitalization for exceptional cases as it is now, and it's clear that it's very exceptional looking at the few cases where it is used. The second element I would like to strengthen is the further close coordination and cooperation that the CMDI review asks from all stakeholders, and this is key. I think the cooperation between the ECB and the SRB is working really well. We have most or many of the elements that will be in the CMDI already in our bilateral MOU, which is a public MOU, but these coordination efforts, enlarging them and strengthening them can only help, so we fully support that. And the last point I wanted to mention is the new tool that is included in the review, which we are calling it the early warning of the SRB by the ECB when we see material risks that one or more of the conditions for failing or likely to fail would be met, we need to start this early warning. In practice, it will not change that much because we are involving the SRB already at the very early stage of the process. We have Single Resolution Board members attending the relevant topics in our supervisory board. We exchange at a very early stage of any crisis situation. So we think this is already there, but still it will be now a formal criteria where we will need to inform the SRB and include in this information what is our assessment of the situation, what is our assessment of what could be possible solutions that may prevent the failure of Rampart's bank within a reasonable time frame. And we would also continue and strengthening the dialogue with the SRB in this case, and we would be able to assess also in terms of what could be early intervention measures and measures that we would ask the bank to take, also comparing to the resolution plan that the SRB would be thinking about and trying not to undermine then the possibility of going into resolution if things go to worse.
Thank you very much, Sophia. And indeed, let's continue with our fictional scenario. So if things were to become worse, Sebastiano, could you tell us briefly why CMDI would make a difference for resolving Rampart's bank?
Indeed. Let me take up from where Sophia left, essentially. So we have already a well-developed cooperation between the SRB and the ECB, the SSM in particular, but also with the ECB in general, so access to data, also thanks to the SSM work. So this is all very much already in place. The proposed legislation puts it in the level 1 text, this cooperation and collaboration, particularly the early intervention case, because all the effort here is without, of course, undermining and prejudging the work of the supervisors who have to do the most to try to address the fragilities of the bank, but in any case, sufficiently in time in order to have an effective resolution. So let's assume that there is, unfortunately, notwithstanding the efforts, the resolution. So how the CMDI helps? As we have seen, this is targeted to small and mid-size banks, which are already resolution, have been turned into resolution because of a peer test which is positive, and this you can use the DGS bridge because the least cost test leverages on the single tier, and therefore it becomes possible to overcome the least cost test. So it's more economical, as a matter of fact, to use the DGS in resolution to bridge the gap. If eventually, this has to be, and Dominique was very clear, this has to be clarified. First of all, since the bank is earmarked for resolution, we would take the MREL to absorb the losses. Now, in the presentation that I made, which was a worst case, I am assuming, in order to assess the impact, that you need the DGS. Not guaranteed that you need, but maybe that you need. On top of that, you need the DGS to arrive to the 8%, but you also may need the SRF. And there is, as has been the assumption, 5%, which is the standard measure that is taken into consideration, and it is in the legislation. And this all assumes that the loss is so high as to require a DGS bridge until the 8% and the SRF. After that, or earlier than that, with the transfer tool, the bank is earmarked for resolution but has a transfer strategy, then the losses are covered, and you can transfer the bank to some potential buyer. This means that the bank, if it is earmarked for resolution with the transfer tool, has also to work. So it's not only MREL, but it is separability, it is a virtual data room, which is also in the legislation, envisage, it is the preparation in order to be effective to use the strategy. And clearly you have also, this is for the resolution authorities, of course, to have a list of potential buyers that could be activated, sounded according to the business model of the bank. So as you see, these are all a number of elements which are in a sequence and which would help with the least possible disruption to take the bank, not of course in itself take to life, but to be taken in the hands of a stronger buyer in order to maintain the critical functions and not to affect the financial stability. Thank you.
Thank you very much, Sebastiano. Isabel, let's come to you now. The European Banking Authority was asked to give some technical advice before the CMDI proposal was adopted. Can you tell us one or two main findings from that advice, preferably for my benefit in a non-technical way? Thank you.
Thank you very much. And first of all, apologies for not being with you in the same room. Maybe I take the role of the at arm's length regulator today, but I'm happy to be with you anyway on this hybrid mode. So thanks for the question, and maybe to start telling a little bit of the essence indeed of the key findings. So the focus has been first on the capacity of banks to access either the DGS or the resolution fund. And in particular, as also Sebastiano highlighted just now, for the mid-sized banks. The other aspect, obviously, is the possibility for the DGS, the schemes, intervention under the current credit hierarchy. That's very important. And also the single depositor preference, which is now proposed in the CMDI. So this is comparing where all deposit ranks pari passu. For everybody to be clear. So this capacity of the small and medium-sized banks to issue also the sufficient loss absorbing financial instrument is again reconsidered, and previously the EBA had already issued a preview report in this regard. So these are the aspects which were looked at. So what we find, maybe I can say more or less in 3 points. First of all, it is important in reading the results to remember that the DGS intervention is inter alia, it has been reminded already, conditional upon the list cost test. And this one requires that the DGS indeed is kind of less costly than reimbursing the covered deposits in insolvency. So this is always the comparative benchmarks. So to do that properly, one needs to remind himself or herself that this depends not only on the creditor hierarchy, but also on the recovery rates which are assumed. And this may depend on the bank, this may depend on the crisis scenario. So it's difficult really to estimate this with just one single figure. So you have to accept that there is a sensitivity. So the impact of recovery rates in the report is indeed shown with a range of sensitivity, and it shows that this is key in impacting the magnitude of the impact of the different options, and it's evidence in the analysis. So first thing, keep in mind what you make as an assumption with the recovery rate. Second, what we observe also is that the possible intervention of the DGS increases, but to a lesser extent progressively. So when we perform this sensitivity analysis, depending on how we change the recovery rate, for instance, from 85 to 50%, the DGS funds available will indeed increase from 50 billion under the current creditor hierarchy to 21 billion under the single depositor hierarchy. However, this would not alter the conclusion of the analysis in relation to the capacity of institutions to access the resolution fund without the deposit. So there is this double effect that has to be seen in regard. And maybe the last point, which is worth telling up front here, is that on the capacity of the mid-sized banks to access the market for MREL, and the instruments, the report shows again that issuing capacity of mid-sized banks may vary, but we could not identify specific types of banks facing issues. So you can't put in a box, okay, this type, be it by the size, be it by the business model, should be more identified with difficulties. No, rather, it is found that banks facing difficulties were banks with intrinsic issues. So we are back with the dialogue of Sofia with Sebastiano just a minute ago, where it is important that we detect as early as possible the difficulty. So this new analysis that we reiterated is now complemented with a wider analysis on the cost of the MREL. And again, the findings go along with the similar conclusion that it's really depending on the intrinsic difficulties of the banks, not just the fact of being a smaller bank. So we will continue progress this situation. I hope I was using a sufficiently familiar language so as to answer your question. Thank you.
Thank you very much, Isabel. Yes, extremely clear. We're going to stay with you for the next question. So the CMDI proposal would give an important role to the EBA to define the so-called least cost test. Can you explain to us what this test is and why it's important to have convergence on it?
Okay, so let me continue. So I think I said already a little bit about the least cost test, where we will need to compare the cost of the DGS intervention to prevent the bank's failure with the cost of the DGS to transfer business to another bank, for instance. So there will be, again, some hypothetical scenarios of the payout for the covered deposits. So these are the range of options. So how it works, indeed, what we identify and would like to share also with the audience is that the current framework provides kind of little detail on how the test is performed. And what we observe, and I'm sure we have run a survey on that, which was part of our report and opinion, is that, of course, it's quite divergent at this stage, how the implementation of the least cost test is made across the member states. So what is of particular relevance, for instance, is that the source of costs ought to be taken into account when considering the counterfactual of the depositor payout varies a lot across the member states. The lack of this detail in the current framework means that any member state can use its authority to take into account counterfactual of only the amount of DGS fund that would be used to reimburse the depositors, while in some other member states, such assessment may also take into account the operational costs of the payout and indirect effects also on the wider economy. So this loose present definition would also have impact on the business that would lose money in the liquidation. So we are in very, very different ways. So what we would want to do with the incoming mandate is possibly to have a better design of why the LCT least cost test matters, first thing, so that we evidence where there is a need to be more precise and why. And then we understand of the legislation that what matters probably in the first instance is to harmonize how the test is done, about the methodology of the calculation, and in particular, as I exemplified for you in the first instance, what are the estimated costs that should kind of compute or in particular whether and how to estimate the operational expenses, for instance, or as I have highlighted already in the previous question, as a matter of fact, what could be the impact of the expected ratio of recoveries, solvency, for instance. So these are all the assumptions that we have to search. We welcome the best clarity in the level 1, what we want to achieve with this cost test. Is it a very micro perspective, or do we embed more macro impact? I think it was a similar issue that we had with the PIA as a test, as a matter of fact. And for us, we would go very much step by step, so as to close as much as possible with a good understanding of the legislation, and also in terms of also see that what could mean the risk test cost and what is its scope may be very much varied from states.
Thank you very much, Isabel. Martin, we're coming back to you. So one criticism we sometimes hear, including from the European Parliament in their first debate, is that the deposits of large corporates should not stand in the same ranking as households and therefore recover funds at the same time in a liquidation. Can you explain the rationale for this, and where do the deposit guarantee schemes fit in?
Yes, thank you. No, of course, the common depositor preference and the single tier are somewhat difficult to explain politically, but we nevertheless think that intellectually and technically they make a lot of sense. So we are still hoping to win this debate in Council and Parliament. And I will say a couple of words why. First, we see good financial stability reasons. What we have seen in Europe, but also in the recent turmoil in the United States, is a reluctance to bail in any depositor, and not only certain types of deposits. And indeed, bailing in corporate deposits or the deposits of financial institutions may have destabilizing effects, and that may jeopardize financial stability. And it may be that the resolution authority prefers in certain circumstances to shield all deposits from bearing losses in order to protect financial stability and avoid bank runs and contagion. So that's the first reason, financial stability. We also see some practical and operational reasons. Indeed, it can make sense to preserve the integrity of the entire deposit book, to transfer it to a buyer. In many cases, a buyer will be reluctant to buy only a part of the deposit book, leaving some non-eligible depositors bearing losses with possible risks of runs and contagion. And a third reason is economic. We think that transferring all deposits to a buyer may simply be the most cost-effective solution for the DGS and society as a whole, in comparison to a DGS payout scenario, which may actually be quite expensive. Very important to underline, the protection of covered deposits will not be impacted in any way, because this protection is afforded by legislation and by the mandatory exclusion from bail-in, and the fact that the DGS has to repay holders of covered deposits in case the accounts become unavailable. So that's important to recall. And also, we think that the actual impact of the common depositor preference may in the end be relatively limited. We are talking of medium-sized and smaller banks, here, which hold a larger proportion of retail deposits and relatively few wholesale deposits. So from a quantitative standpoint, the proportion of non-retail deposits that would be protected by the single tier would be limited, and therefore the impact on DGSs would be limited as well. And secondly, it is important to recall that this is only an option. The single tier does not give an implicit guarantee that all deposits will be shielded from bearing losses. It is a flexibility given to authorities to enable transfers in resolution only when justified by the resolution authority on financial stability grounds. So again, it doesn't mean that all deposits will be protected in all cases. The assessment will remain a case-by-case one, taking into account, firstly, financial stability objectives.
Thank you very much. Sebastiano, again, to make it more concrete, we know that the CMDI review is not a response to the US and Swiss events of earlier this year, which has been mentioned a couple of times already today. But is there anything in the proposal that would help us deal with a similar case, the banking union?
But as I said, here, clearly the CMDI is not an answer to the banking turmoil of last March. However, the focus on the use on a transfer tool for this mid-sized bank is essentially what is helpful. First of all, because the bank has to exit the market because there has been a failure. Therefore, we are not, so the proposal does not allow essentially to retain the bank in the market as a standalone. And secondly, because through this better availability of funding, in case, as Martin said, in case that it is necessary to essentially shield some depositors or all of them from the absorption of losses, then this would avoid financial disruptions, to avoid the preservation some of the functions that the bank could deploy in certain markets, and ensure a, let's say, efficient solution to the crisis case. I want to add that, I mean, as I showed the impact for the DGSs of playing this role as bridge would not be in the vast majority of the cases very substantial. So it can be done. It is rational to do it, and many times is less costly than a payout. But on top of that, since the costs of the DGS are also to pay for banks that remain in liquidation, where in this case there is liquidation, so national insolvency procedures, normally pay box functions, so reimbursement of deposits and taking back then the proceeds of the liquidation. Also in this case, I didn't show in the slides for reasons of time, but we have estimated that for the banks of our sample that would remain in liquidation, the impact of the DGS ranking pari passu, that's to say, to have covered and uncovered depositors being paid at the same time in the percentages that they represent, pro rata basis on the real estate liquidations, then in the estate liquidation, then this is not a substantial impact, and for various reasons, even for the banks that are not in our sample, because the banks that are not in our sample, the vast majority are banks in simplified obligation. The banks in simplified obligation, for 80% of the cases, are assisted by the IPS, which should intervene before. And therefore, also here, the impact would not be sensitive, and you know that the IPS can be used in certain cases also as DGS. Therefore, there is an overall shield from substantial impact. And in our estimations, this would be for the banks remaining in liquidation, so where the DGS ranks pari passu with uncovered depositor, would be 5% of the available financial means calculated for all the DGSs of the banks involved. Thank you.
Thank you very much, Sebastiano. And for our last question, Sophia, let's try and look a bit to the future beyond the CMDI. What else do you think we still need to improve for the banking union for the benefit of us all?
Thanks a lot, Susan. Well, first of all, we would really welcome a swift finalization of the legislative proposal and that we have CMDI adopted, because this would already increase the optionality that will allow us to tackle each crisis with what is required and is in place. We would also like to stress that this Commission package is not enough in itself to complete our banking union. So we see it more as an intermediate step. And the important project to complete the banking union is critical. So we need then to continue working on that, to put in place the third pillar, and to have the European Deposit and Insurance Scheme in place. This remains for us a priority, and I would recall that the Commission has a legislative proposal on the table already since 2015. We hope to see some decisive progress on this file, and we think the CMDI review can help that. The second thing, it's important to make the backstop to the SRF operational as well. So we hope that can be in place soon. Andrea mentioned it already in his introductory remarks. We are still also missing a framework, a European framework for liquidity in resolution. And we also see that we would also welcome further harmonization of other elements of the crisis management framework in the future, if we are talking about the future. For example, having more harmonized bank insolvency frameworks would be something that in our view, and in my view, would really help having a strengthened framework in place. I think all of these would benefit citizens. As supervisors, we are working on a number of other things. We see that there is still space for a more integrated market, so for further integration, and we would like to see that. We see that there is still room for consolidation in our banking sector, so that's something that we think would be benefiting all citizens, all European citizens, and we see room for that. And maybe finally on what we are really paying a lot of efforts from our side as well, we see that the banks and the customers of banks are moving into a much more digital world. So also there, having a better way to supervise these and having more interactions to have banks more efficient, more innovative, but also addressing the risks that the different risks that this can bring. And finally, last to mention, just the risks that are already in the market, like climate-related financial risks. It's an important element that we are also trying to cover from our supervisory side, and we see banks doing progress, but not at the speed that we would like them to be doing, and always having an eye on any other kind of emerging risks that may come to the system, and being ahead of the curve, being able to tackle them.
Thank you very much, Sophia. I think there's still plenty of work to do. In the interest of time, I'm just going to take a couple of questions. Martin, the first one is for you. You might need your crystal ball for this because one of our online attendees is asking, when do you see the CMDI coming into force? Could it be next year?
I don't have a crystal ball, but I can safely respond that next year would be very early. No, the Spanish presidency is doing a great job in the council to move the file forward. MEPs in the parliament have been working very hard and are finalizing their reports. But having an adoption with this parliament looks exceedingly difficult, obviously. So we'll need to wait until work can resume with the new parliament at some point in 2024. And even then, we will need to have, we will probably have still quite some work to do. This is a wide-ranging file, very complicated, very sensitive politically. So we need to take the time to get it right. I would be extremely happy if we were able to come to an agreement between Council and Parliament at the end of next year, which would mean entry into force in the course of 2025, and of course, entry into application a bit later than that. If we manage that, I think we would all be very happy, provided, and this is essential, that we maintain the intellectual coherence of the package together. Of course, Council and Parliament will make changes, they must make changes, but we need to maintain a package that is internally consistent and that really addresses the failings that we have identified.
Thank you very much. We've had a lot of questions about MREL. We will come back to you and publish, I think, a Q&A in the coming days or weeks. But let me take one question to both Sophia and Sebastiano. Given the fact that most small or medium-sized banks do not have access to wholesale markets, how can they meet MREL requirements? And would that not be a threat to their stability, as it would be quite cheap to destabilize those banks through short positions?
So clearly, for a mid-sized bank, it is more complicated to access wholesale markets. But it is not impossible, I have to say, particularly in certain windows of opportunities that we have seen in recent past, that banks have issued quite substantially, if not for other reasons, to fulfill the MREL shortfall that they have to fulfill until the end of this year. And this applies both to banks earmarked for resolution, which are SIs, so significant banks under the SRB, and for a few LSIs banks. I have to say that the shortfall for the banks earmarked for resolution, which are LSIs, are clearly very smaller in terms of size. And I think that in the LSI report that the SRB published, there is also an overall aggregate figure. In any case, for all the banks earmarked for resolution, you will have the MREL data published as of beginning of 24. So there is no secret in this case, and we have our MREL dashboard that monitors, particularly for the LSIs, the path towards fulfillment of the target. So in a nutshell, after the Ukraine-Russian war, of course, the marks were freezed. Then they started again. In the third quarter of 22, we had some fears that particularly certain type of banks couldn't issue the market, couldn't access the market, or could issue at very high prices, also because at the same time started the increase of interest rates, but then the situation started to gradually improve. Rates are still clearly higher than pre-wars or pre-COVID, if you want, but this is also due to the monetary policy impact, and we have seen that various banks have managed to issue. Now, over time, it will be important also to assess whether this is only a conjunctural issue and therefore can be addressed depending on the situation, or there are elements of structural issues and therefore that would merit some other treatment because otherwise there would be an undue impact on business models. As of today, it seems to me that even smaller banks have managed to cater for this. Thank you.
Maybe just very quickly adding that this would not be from one day to the other, no? So also for significant institutions, there was a phasing in on the MREL requirements, and this would need to be given. And as Sebastiano was saying, we need to look into the context and see and monitor closely what is possible and what not, and then imposing the targets, also taking that into account. But of course, these banks, and again, it's not all the banks, will be the banks that are earmarked for resolution, would then need to be able to get conditions to access the market. I would again stress that the work would not be only on MREL, and I think the importance of having the banks then prepared to be resolvable will imply a number of other preparations that we will need to and the SRB will closely monitor, and we will be happy to be there also to assist that.
Thank you very much, Sophia. Now, please join me in thanking our panelists for their insights today, Sophia, Isabel, Martin, and Sebastiano. Thank you very much. Ladies and gentlemen, let me now invite the chair of the Single Resolution Board, Dominique Laverex, to wrap things up for us with his concluding thoughts. Dominique.
Thank you, Susan, and I think it's the time to wish you a good afternoon. It's just gone afternoon, I think. So, well, I think we've had an interesting mix of discussion and debate this morning. But before going to some lessons I've drawn from these interventions, let me first of all send a word of thanks to all those who took part in that discussions. We had a top-class range of speakers and contributors in this seminar, and I know that they all have busy agendas. So many thanks for being with us in Brussels, Annelie, Andrea, Sophia, Martin, Sean Berrigan, and Isabel online. Obviously, thank you to each of you. I would like also to thank the ECB team, because beyond our interventions, obviously, it's a collective work, ECB team and SRB one, because it's a lot of preparation, obviously. Let me mention, I don't know, but at the moment we were near 600 participants online. So it shows the level of interest we've raised with this workshop and with this seminar, and I think it's a very positive element to underline. So let me go to some thoughts listening to what was said. Let me start again from what Sean said earlier in the morning. We've come a long way. If we look at the events of this decade, not 20 years ago, but the 3 last years, COVID, invasion of Ukraine, Archie goes, Green Seal, Credit Suisse, the turmoil in the UK, etc., etc. So we can see that the European banking sector has been resilient today. And this is certainly based on a good and intrusive supervision, a good solvency, liquidity, and resolvability requirement framework. And so let's underline that we can say that this resilience is based also on our efforts in Europe and in particular in the banking union to improve the situation of yesterday, a long time ago. But nevertheless, we must remain vigilant and diligently work to maintain our financial stability, and even more, we want to promote it within the banking union. So that means that we need to sharpen our tools in our kit and adding new ones. In that sense, we know that the crisis management framework is already strong, but remains incomplete. And from time to time, based on our experience of the recent years and of the recent cases we were confronted with, this framework is not able to smoothly tackle some issues related to bank difficulties. So this is exactly what CMDI is about. It's a clear improvement to our framework. So that means that these proposals allow us to better protect depositors and taxpayers at the same time. To some extent, we did two birds with the same stone. So today we have heard strong support by the two banking union pillars representative for the dual improvement of an expansion of the public interest assessment and new source of funding in case of a need. However, it has been underlined several times that it's not possible to support the expansion if it comes without the tools to deal with additional banks earmarked for resolution. We really hope that the co-legislators will be able to find a solution which allows for an expansion of this public interest assessment, but also allows a sufficient increase of the funding possibilities. We tried today to provide our technical expertise to help them in this endeavor, and we stand available to continue supporting. As we've seen today, the proposal has a lot of positive novelties that go beyond the dual proposal of expanded PIA and its funding. It improves the crisis continuum from the early exchange of information to preventive and recovery measures. It tries to prevent limbo situations mentioned by Andrea, to improve disclosures, to improve alternative measures, and so on. I would appeal to the co-legislators, if it's not possible to adopt all parts of the CMDI, quote known as the lawyers say, meaning it should be possible to adopt the full CMDI, but supposing that for 1 minute it's not possible, please think about adopting as much of it as possible now, not in 2 or 3 years. This is important to send a signal of trust into the banking union now, and ultimately to make sure that we can resolve our banks more smoothly. In 2022, the Eurogroup, not being able to already agree on a roadmap to a full banking union, took a commitment to improve the crisis management and deposit insurance framework. That's exactly the moment to act. Thank you very much.
Thank you very much, Dominique. Just before we officially close, please note the recordings of this event and the presentations will be made available on the SRB and ECB websites. And then on behalf of the whole ECB and SRB teams, a warm thanks to all of our speakers and especially to you in the audience for your active participation today. Thank you and goodbye.